Welcome back to Turpentine VC, a podcast where we discuss the art and science of building successful venture firms, VC to VC. For today's episode, we have Ali Hamed. Ali is a partner at CoVenture, an alternative asset manager specializing in venture, specialty lending, and crypto. We discuss the advantages of investing across asset classes, CoVenture's inflection points, the importance of being liked in venture, why LPs are willing to accept lower returns from big brand VCs, asset classes Ali hopes to invest in the future, and much more. Here's our conversation.
Holy smokes, it's the world famous Erik Torenberg.
Hey, what's up, man? Great to see you. Happy New Year.
Happy New Year. Happy New Year. How you doing? You made the big announcement. So I remember we were talking, we were like, dude, this is like top secret. Like nobody can know. And I was like, okay, man.
I was saying I either have to tame myself a little bit because people are like, oh, you're doing too many things, or I have to just go full me. And I'm going to try going full me and seeing how that goes.
I love that. Full send.
Yeah, exactly. You're one of the most interesting venture capitalists in the game because you don't only do venture capital, or you don't only think about this asset class. You think about other asset classes, and you think about building an asset management firm. Give some context. What is CoVenture today exactly, and how did it get there? How do you think about like the type of firm you're building? Because it's different than any other venture capital firm that's been on this podcast.
Yeah, we have So the CoVenture Group has three main strategies. We do early stage venture capital investing. That's at a crossbeam. We have our asset-backed credit business, where we find tech companies that are making loans or might call themselves specialty finance businesses, or they need capital for something other than general operations. And they might be buying a company that has a cash flow associated with it, or they might be financing a home or a hard asset or a soft asset like a receivable, and we'll provide them debt capital to finance those assets. And then we have a business that we call the hybrid business, where we're finding companies that are mature, they're already profitable, they were thinking about selling, but they can't agree with the market on price, or they're thinking about doing a growth equity round. And there we'll do $50 to $150 million investments to provide capital in a reasonably structured way to help with the mismatch of price expectations between founders and investors. So those are the three main businesses that we're in. And so that is who we are and what we are today. There's 35 of us ish. We probably invest $500 million to $1 billion a year. We'll do 20 to 40 transactions a year usually. On the venture side, our deals are usually $500,000 to $3 million. On the credit side, they're as small as $25 million. They'll go up to $500 million. So it really just kind of depends on the strategy. But that's us in a nutshell.
And why don't you just do venture capital like everybody else? Like, why are you doing these other things? Why don't other firms try to copy your strategy? Like, what secret powers do you have there? Like, say more about this.
Yeah. So every asset class is imperfect in its own way. I think in credit, people spend too much time focused on the security and the structure of a deal, and probably not enough time on the company itself. The analog in venture, by the way, is venture capitalists spend too much time maybe on like founding team and market, but they get like the wrong company in the right market. And I think it's like a very thesis-oriented asset class, and there's probably like not as much rigor as there should be. And just like examples, by the way, of how a venture mindset though might help credit. Like credit's a weird business in that like the best way to be a winner in credit is to be the biggest winner in the space. But it's hard to be the biggest in credit. Like there's big firms, there's Blackstone, there's Apollo, there's all these different firms. And so the best thing you could do is take your venture hat, which is like looking for new markets that don't matter yet, but might matter a lot tomorrow. Be the biggest at scale player in a very small market today and just grow with the market over time and continue to dominate. That's like a very unique approach to credit that other credit investors don't have. And we only have that approach because we have a venture DNA. In venture, there's a lot of good things about venture. I don't think rigor is one of them. I think people could do a lot more to underwrite the companies they're in. And in our credit business, we live, breathe, and die over every basis point. So it's like too rigorous. And so I think that we benefit from the pluses and minuses of that. And also in different vintages, different parts of the market are interesting. Like right now, the hybrid business sees tons of deal flow because there's a huge bid-ask spread in investors and founder expectations, and there's a ton of deal flow. I think for the last 2 years, everybody in venture has been wondering when valuations are going to come down. Oh my God, the market is destroyed. Why are people still raising their seed rounds at like 20 pre and they've never founded a company before? And it's like pre-launch. And so when you're in only one asset class, you kind of feel forced to invest whether or not you should be investing in every vintage. And when you're in multiple asset classes, it's not that you get in the market or out of the market, but you slow down or you speed up. And it's really easy to see relative value. And, like different companies need different types of capital. I mean, being able to invest in companies in a few different ways just triples our deal flow. We see a company and we have 3 different ways that we can invest in it. And so instead of trying to force the company to work within the confines of our business or force ourselves to put money out in a vintage where maybe we shouldn't be putting money out, the firm is always investing. We're just going up and down the capital structure depending on the vintage and the nature of the vintage and what we should be doing. I think having a bit of credit heritage, to our venture, LPs, I tell them gosh, thank God, we went through a bust cycle and I bet you were a lot more durable because we know how to do risk management and protect against the downside and manage hard situations. And, I think when we're at our worst in venture, we might be too linear of thinkers. We do a little bit less of a job of imagining what could be because we're neurotic credit guys. And, we do diligence, which, so we don't do deals when we meet companies after 5 days or whatever. So we're idiots or I don't know, whatever we are. But when we're at our best, it means that we can win in both boom and bust cycles, which we think we're doing. And it's been pretty good. When things get hard, that's our sweet spot. I think people in venture probably struggle to have hard conversations. We professionally have hard conversations all the time. And by the way, hard conversations don't mean mean conversations. They just mean intellectually honest ones, or how do we get through this together as partners? So I think there's a lot of benefits.
So say more about that. Which hard conversations are venture capitalists not having that they probably should be having?
I think VCs just like being liked. And it's a business where being liked and being accepted is important because the value of companies in many ways is often based on just the consensus. In private equity or something, but the knock on private equity is too much focus on the company, not enough focus on the market. Private equity funds specialize in investing in good companies and crappy markets sometimes. I'm sure a private equity investor listening to this would be that's not true, but many of them do. And it makes sense because in private equity or credit, the reason you like a company is did it make money? You underwrite to a multiple, or you underwrite to comps, or you underwrite to a discounted cash. You're basically underwriting data. You're not doing a deal because some famous venture capitalist was that's a great market, you should do it. And in venture, it's such a scary business because you're kind of investing on hope and imagination and what could be, that you want a crowd of smart people who've done it before to like a business. And, you rely on a crowd to like you so that they do the next round. In venture capital, we're all a bunch of merchant bankers. We have a small little balance sheet. We put a little bit of our balance sheet to a company. We try to sell equity to somebody else at a higher price. And we get paid we don't get paid advisory fees. Instead, we get into a round at too low a valuation if we're perceived to be able to help the company raise their next round and be accepted by the community. And so because of all those needs to be accepted and liked, we say a lot of things to companies, not because it's the right thing for the company to hear, but because we think it's going to make people like us more. The other board members are going to like us. The founder will like us. We'll get positive references. There's all these blogs and forums where people write nice or mean things about the VCs that they've met. And they're very rarely we had this really good intellectual debate about the company, and it was they liked me or they didn't like me. So it's not because people are irrational or stupid. It's just a good way to be. It's one of the popular ways to be good at venture capital. And hard conversations, there were things hey, look, are you ever going to get beyond this preference stack? Do you really want to keep running this company for that long, or should we try to sell it? Or, I think a lot of founders, for example, they're so used to a rah-rah culture, and they're afraid that if they admit that things aren't going well, employees might leave, or the non-believers will leave, or they don't want to do a layoff because what would that do to the culture? Would the good people leave because the bad people got laid off or let go or whatever? And those are all natural, normal things. And it's not about being a good partner or a bad partner. I'm not suggesting that having hard conversations is the goal is to rip value away or be a jerk. It's actually kind. It's more kind to somebody to be honest with them and let them know where things might be. And I don't really see a lot of the famous now Elon Musk interview. I thought my favorite part was it's people want to be perceived as being good, not actually being good. I was yes, that's so true. I think VCs care a lot more about being perceived as good as opposed to actually being good.
Right. Yeah, no, that makes sense. There's this quote saying, "Don't be the best, be the only." Are you the only firm that's doing things the way that you're doing it in terms of venture, credit, growth? How do you think about that?
We're all our own little snowflakes. No, probably not. Like there's plenty of people who have done, investing across asset classes. First off, like most of finance is that way. Venture is like one of the unique asset classes where it's like, no, we do one thing, we do it really well. And, I'd say like there's a lot of consolidation in financial services, asset management. I think we're probably one of the few firms that has like a venture capital fund and an asset-backed credit fund and a hybrid fund where we focus on largely growing companies and tech-enabled companies. But, Victory Park invests in asset-backed credit. Atalaya does. There's a lot of people who do that. There's a lot of really good seed funds. Obviously, maybe there's too many good seed funds. And I mean, firms like Soros have been investing in the equity and debt of companies forever. So, I think there's definitely unique parts of what we do. I think that we have a unique point of view on the world. I think that like if I was just another seed investor, Erik, I think you'd find me a lot less interesting. I'd just be like another knucklehead running around with like $500,000 to $3 million checks to sell to people. But I think by being in these other funds and asset classes, we develop a unique point of view. And it turns out that being in venture capital, it's important to have a unique point of view.
And so if you were an LP, specializing in emerging managers or just venture period, would you be more excited about funds that were in different asset classes? Like, there's thousands of venture funds, nearly all of them are just in venture. Should more venture firms and, managers listening to this podcast think about getting into another asset class?
If it works for them, I think that what I would do as an LP is try to like lean into the sincerity of the manager. And like, is the story honest? Like when people raise funds, you can either raise fund on a really good track record, a really good narrative, or from people you already know. And most people who raise new funds don't already have a track record and they don't already know a bunch of people who will give them $100 million. They come up with these like cockamamie stories of like, we're going to be a sector focused fund or a geography focused fund, or like, we're going to be the strategic fund associated with this or other organization. We're going to add all this value. And they come up with like all these made up stories because it's good for fundraising. And the story, like they shouldn't be stories. They should just be like, this is who we are. And, this is what's sincere to us. And we think that we're good at it. Like, I mean, it works for me because I'm like a neurotic, curmudgeon-y, like nervous guy, and so like, how am I going to be different in venture? I'm going to like find other founders who want somebody who's going to be like worried about their company in a positive and constructive way. Like, but we have the imagination, like we're still looking for unicorn companies, but probably my closest friend in venture is this guy, Jesse at IA. And we always joke, we're like best friends, but like we've been spending 10 years trying to co-invest together. We never have. Like if like we joke, like we couldn't compete with each other if we tried to, because we've been trying to co-invest. And he just has a different approach, and they're like the opposite. They're incredibly focused. They invest in long feedback loop companies, a lot of technical risk. We often invest in short feedback loop businesses, a little bit less technical risk. Not always, but often. So I think that the LP should look at the manager and be like, what's right for the manager? I mean, with you, Erik, like imagine if I try to be more like you. Like I just don't have it in my backbone in my body. I'm not as good with a mega fund. I mean, the thing that makes you so special, like in venture capital, what you're supposed to do is you're supposed to take something that's like a contrarian idea that not many people like believe in. And then like you're supposed to invest in the company and then tell the world why they were wrong and now they should believe. And like you have this insane microphone and megaphone to go do that with. Like it's not as natural for me. So I have to win in a different way. So I think an LP shouldn't do a fund or a strategy because it's associated with other funds. They should do it because they think it like aligns with the sincere strengths of the person they're talking with. If I imagine I try to build a media company and like an education company along with my venture capital, I'd do it so much worse than you.
Right. But you can also build out your team to bring strengths that, like, if you believe in a strategy and you don't have the right skills in a strategy, you can grow your team. And you've done that, right? You got 35 people, you have people with different skill sets. Talk about how you thought about team building at CoVenture and where are you going? Like 5 years from now, what are you trying to turn CoVenture into? And some of that is, bottoms up in terms of the skill sets that you have. But also some of it is also, I'm sure, like, where is the world going? Where is their opportunity? Where is their white space?
Like the two limiting factors of our firm are, or I guess maybe like the two things that you have to struggle with in terms of how fast you want to build a business. Like one way to build a firm quickly is raise pretty non-discretionary funds. Like the extreme goalpost of that is like single name SPVs. And it's easy to raise a lot of money for that because people don't really need to trust you as much. They just need to look at the deal and feel like you have access and like hopefully your diligence materials aren't terrible. And then like you have like a sector focused fund or a geography focused fund or a very narrowly focused fund, which again, that's great for narrative. It's probably worse for investing, but it's good for narrative. And like it makes you credible. And like for an LP, it probably like limits the downside because they can push it through IC and they can understand like why it works that way. And then like the most extreme is like if I went to somebody and said, you got to give me money, I'm not going to tell you what I'm going to do with it. I could like buy like asteroids and I could buy, and I could buy companies and I could buy income share agreements and I could do anything in the world. And like there's groups that do that, not many. But that would be like a much slower way. And there's people in my life who would probably, give us capital, do literally anything we wanted with, but probably less than people who would give us capital for a certain strategy. So like when you think about how fast or slow you build a firm, it's like how discretionary do you want it, the funds to be? And, it's a compromise. You could either build an overly simple firm and probably build a little bit more slowly, or a slightly more complicated firm and build a little bit more fast. And so that's like sort of the pluses and minuses. And then in terms of people, which is the question you actually asked, it's the same sort of conflict. The way to build a firm faster and a company faster is you make a lot of senior lateral hires because you're hiring people who know how to do stuff already. And if you're trying to grow in like turbo speed, you're building a software company that sells into law firms, you should hire a former VP of sales of a software company that sells into law firms. The problem though with older people or more senior people is it's not that they're better or worse, it's that they have different decision-making style. By the way, there might be some negative selection bias. Like, is the best person who's like the chief something going to really leave if they're actually that good at their job? Sometimes, but less often. But it's really decision-making style. Senior people have a way of doing things, and they might have different risk tolerances or not risk tolerances, or they might be used to managing a big team versus a small team. We have a term internally called like iPad guys, which are like the types of employees who show up with an iPad because they don't do their own work anymore and they orchestrate a team of people. The other term we have is like, can this person pass the typing test? Like, do they do their own work? That's a cultural thing that's important to us. But a fast way to grow the business is to sometimes hire iPad guys, people who are senior and know how to do stuff. And you're going to take some cultural risk along the way and maybe some performance risk along the way. So that kind of sucks. The best way to grow a business is, you want to hire young people and then grow them organically in the organization because, they'll filter the top. They know where to find stuff. They have a lot of social capital in the organization. They have clout. They have a decision-making style that's similar to senior management because they've been taught by senior management. The problem is you got to wait for them to grow. Like if you think about Goldman, like the pre-IPO version of Goldman, like the partners had been born and grown at Goldman. I mean, if you talk to somebody who was at Goldman, even if they're at a firm 3 firms after, they still consider themselves a Goldman person. Being a Goldman partner was part of their identity. If you think about, like, I think Apollo's status, like the average partner has been at Apollo for 18 years. And so those are franchises that have had the opportunity to grow these people. They've developed these people, and that's the best way, but it's a slower way. So you ask where the firm is going. We are in service of our LPs, of course, and we're in service of our portfolio companies and where are the market opportunities. But I think the thing that people underappreciate is how much where our firm is going is based on making sure that the people in our organization have a place to go. One of the assumptions that we make is that ambitious people make for better investors than unambitious people. Not a very controversial thing, I don't think. And so the problem is, but in venture, for example, like we'll never grow the firm, never get too big. And agreed, by the way, getting too big definitionally is wrong because you had to put word too in there. But an ambitious person wants to develop in their career. And so they can either develop because they added scope to their job. And so if the firm gets bigger, then they can add scope because the firm has more scope. And if the firm doesn't grow, they can grow the scope of their role by taking scope from other people. In the case of like Union Square Ventures or Benchmark or some of these like wonderful and unique and rare organizations, there's like senior people who have voluntarily given up scope to make room for the ambitious scope of the younger people as they grow. But in most organizations, it's like people in their 30s and 40s who make most of the money and like people in their 50s and 60s who take all the money because like they don't leave and they're probably not creating as much value as they used to. And I'm sure somebody's gonna like be super pissed off that I said that, but like that's probably kind of how it works in a lot of places. And if you are stuck and you're not growing, then you're gonna like your ambitious people are either gonna get political and start taking scope from people, or they're just gonna leave. And so where are we going? Our job is to find the smartest people we possibly can, try to hire them when they're young, grow them in the organization. And if one of those people either gets more ambitious and qualified, we'll try to raise more money into the funds so that they can just do more and add scope to their lives. Or if they identify a strategy and a thesis and, and it kind of makes sense for one of our strategies, but it becomes a concentrated part of the strategy, we might break it out into its own new strategy one day. And that could take 10 years. So we don't really think about it like we already know where we're going. I think we know that we're trying to find where, we didn't know we were going to be in a hybrid until the market allowed for it. And we had a guy named Dan who was just amazing. And he was doing good deals and impressed us. And we had gone through good deals with him and hard deals that he had been able to work out. And everybody at the firm loved him and wanted, so we developed hybrid.
Hey, we'll continue our interview in a moment after a word from our sponsors. If you're a startup founder or executive running a growing business, you know that as you scale, your systems break down and the cracks start to show. If this resonates with you, there are 3 numbers you need to know: 36,000, 25, and 1. 36,000. That's the number of businesses which have upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, streamline accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down costs. 1, because your business is one of a kind, so you get a customized solution for all your KPIs in one efficient system with one source of truth. Manage risk, get reliable forecasts, and improve margins. Everything you need all in one place. Right now, download NetSuite's popular KPI checklist, designed to give you consistently excellent performance, absolutely free, at netsuite.com/turpentine. That's netsuite.com/turpentine to get your own KPI checklist. netsuite.com/turpentine. Taking the window instead of the middle seat. Outsourcing business tasks that you absolutely hate. What about selling with Shopify? Shopify is the global commerce platform that helps you sell at every stage of your business. Shopify powers 10% of all e-commerce in the US. And Shopify is the global force behind Allbirds, Rothy's, and Brooklinen, and millions of other entrepreneurs of every size across 175 countries. Whether you're selling security systems or marketing memory modules, Shopify helps you sell everywhere, from their all-in-one e-commerce platform to their in-person POS system. Wherever and whatever you're selling, Shopify's got you covered. I've used it in the past at the companies I've founded, and when we launch merch here at Turpentine, Shopify will be our go-to. Shopify helps turn browsers into buyers with the internet's best converting checkout, up to 36% better compared to other leading commerce platforms. And Shopify helps you sell more with less effort thanks to Shopify Magic, your AI-powered all-star. With Shopify Magic, whip up captivating content that converts from blog posts to product descriptions. Generate instant FAQ answers. Pick the perfect email send time. Plus, Shopify Magic is free for every Shopify seller. Businesses that grow, grow with Shopify. Sign up for a $1 per month trial period at shopify.com/momentofzen. Go to shopify.com/momentofzen now to grow your business no matter what stage you're in. Shopify.com/momentofzen.
Is there an asset class that you're not yet in that you know you want to get into in the next 5 to 10 years? We've seen Andreessen and Thrive get to 10-figure, sort of AUM by just doing everything in venture, at all scales. I suspect that they'll get into multiple asset classes too at some point. You've gone into multiple asset classes earlier, but you're more scoped within venture. Paint a little bit more of a picture of if all your dreams come true within 5 to 10 years, what you could imagine CoVenture doing. It's not doing today.
I think probably the main place that we see the most opportunity now is, and it's not a good trade yet because where mortgage rates are and where the cost of building is, and housing prices haven't corrected. But we're pretty fascinated by the housing crisis. I mean, it's sad. I think a lot less people in our generation will be able to buy homes than the prior generation, and the next generation will probably find it even harder. And we have a really serious building problem in the US. And that's partly regulatory, it's partly labor, it's a lot of things. And we've spent a lot of time trying to figure out the right way to solve that. I mean, there's a lot of big problems in the world. There's healthcare problems, there's climate problems, there's whatever, some long list. Probably the one that we feel most passionate about and maybe qualified to have our little dent in the world will be the housing crisis. And I wouldn't be surprised if sometime in the next 10 years, we figure out how out of our asset-backed business, we can develop a point of view on that and then build a strategy around it over time. And I say that because we literally have no opportunities right now to do so. Like we haven't found a single deal that's solving that. We think that a lot of the prefab businesses just consume tons and tons of capital. By the way, I hope they work. They probably will work, but I don't think they're ready for credit yet. And actually, it's interesting. So like these prefab, if you think about lending to these companies, it's sort of like a weird problem. So like on one hand, like if you lent money for a construction build, would you lend at a higher rate for a prefab, like, one of these tech companies that just like prints these homes over and over again, or for like the old way of building things, like the traditional way? Your first instinct is probably, well, it's so much less risky if like a robot is like, or a machine is building these like prefab homes and like they're modular and whatever, and like there's no risk in developing it. And a general contractor, like who's ever heard that they're like development, like they're building, like their home got built on the timeline they thought it was going to get built. But actually the weird problem is your losses are lower in prefab or in one of these modern ways of building, but your severity loss is greater. Because if your general contractor screws up, you can replace your general contractor. But if your like prefab home builder screws up, you can't replace the prefab home builder because all the machinery and equipment is like their proprietary stuff. And so like it's a weird credit problem. You actually lend at a higher rate to a prefab business than to a traditional home builder, even though the traditional home builder will have like a much worse experience client by client by client than the prefab. So there's all these like weird, fun, interesting like credit problems in home building. I can imagine we'll continue to think about it. I hope we find a solution. We're probably years away. The other thing that I think a lot about as we build our firm is, and I guess this is a knock on us a little bit. So hopefully it's not taken too negatively, but like a lot of the best firms were built at like the dawn of their asset class. Like Sequoia was kind of founded at the dawn of venture capital, and Oaktree was at the dawn of like, non-investment grade credit, and, whatever, like Apollo and Guggenheim and stuff probably like won the insurance trade, and they were kind of at the dawn of the insurance trade. And, we were in private credit, but we weren't founded at the dawn of it. We're in venture capital and we weren't founded at the dawn of it. And one of the suspicions I have is in the course of the next, like I'm 32, I'd imagine I'll probably be working for at least the next 100 years or at least, 30 to 40 more years. It's hard for me to imagine that during your career and my career, there won't be a new asset class that gets founded. I think some people thought it was going to be crypto at one point. And I hope we're at the dawn of it. Like, I hope we realize it when that new asset class is getting formed. And I don't know if it's going to be like a new type of investing that's never existed before, or we take like a subsector of investing that like we just rename it. I forgot who I was talking to, so it's not my quote. But they were like, they always laugh when they hear that venture capital has only been around for 60 years. They're like, obviously, venture capital has been around for longer than that. We just came up with a cool name for it finally and became an asset class. So maybe there's something right in front of us that none of us know about. But I hope we get to invest in that. I hope we get to be at the dawn of a new asset class as a firm and hang around the hoop and be credible and have a good track record, and people like us enough where they'll give us the opportunity to be a part of it. And that would be a good way to become a big investment firm. But I don't know what that is yet. It's almost like asking a venture capitalist, like, do you know what deal is going to make your career? Like, no, I haven't seen it yet.
Yeah, it is interesting. I mean, talk about crypto, because you guys have done some stuff there. How have you thought about that asset class and whether to go big or not go big, at it, or how do you think about that?
We thought it was interesting. We still think it's interesting. We see less deal flow in the space. And, I think the most compelling thing for a long time is that, having small talk about crypto is fun. You're talking about like governance and economics, and there's like no such thing as crypto and small talk, right? Like it's an interesting conversation. There's like, of course, like the components of it are still really fascinating. It's like, oh my gosh, like should every big thing in the world be governed by a few small people, or should it be governed by like many, many people where no one's really in control? Hopefully the latter. There's negatives of the latter, which is like it's lower quality. It's democracy versus dictatorships, although dictatorships fall in the end, but they go faster. So all those like interesting parts of like, should the world be more distributed? Totally. Are less of the smartest people in the world working on it? Yeah, a lot of them are working on AI now. It's like probably the reason everyone's like obsessed with AI is like everyone's smartest friend is working on an AI startup now. And so like, part of our job in venture capital is to follow talented people. I think our approach to it was pretty basic. Like in our funds, we basically said, well, we think it's really interesting. We want to own enough of it where if it works really well, we're not pissed. And if it doesn't really work very well, we're not pissed either. And I think we came up with a rule internally. We'll get up to 5% of the fund in things that are related to crypto. If it does really well, that'll be enough where we'll feel like it had a big dent in the fund in a positive way. If it doesn't go very well, it means that it won't like tear a hole in the side of our fund. I think for a lot of people, like it blew a hole in the side of their fund. So that's like the risk management thing. That's like pretty basic. It turns out like you shouldn't have like half your fund in one sector. Like you wouldn't have half your fund in like, unless you're like a prop tech fund, just in prop tech, for example. So we risk managed it. There's a lot less deal flow in the last year or so. So we haven't really, I don't expect that we'll get to the full 5%. And, I think that the stuff that we did in the meantime, there's a couple companies that will do well, it seems. And there's a couple things that we got smoked on, and like we sized them well. And I wish they hadn't lost money. They did, but it really won't move the needle for the fund in a big way. That's how you're supposed to size your venture bets. Actually, you want your failures to fail quickly, because if they fail, if they look like they're winners initially, then you put more money into them, and then they really become expensive losers. You want them to fail like as fast as possible. By the way, that's the hard conversation, easy conversation thing too.
Yeah, is it fair to say that there are some multi-stage firms or even individuals who've been able to raise colossal amount of capital, many billions of dollars, who have not done that well from a multiples basis, but that the LPs that they're working with can put a lot of capital to work and maybe didn't need such a high multiples. And so in some weird way, kind of everyone's happy, even though the multiples aren't that great because the firms made a ton of money.
Yeah. The answer is yes. I think different organizations have different ways of compensating their people and judging success. Some organizations, like in venture capital, there's like at least some alignment that like you get carry, and allegedly you're supposed to make your wealth on carry and not management fees. Although I'm sure in some firms that's not always the case. A lot of endowments or certain pensions or sovereigns. Like I'm not sure that there's some like bonus structure that's you got like the best VC fund, so we're like going to give you a big bonus. So that's probably a problem. It turns out like incentive based pay is like pretty good. Like it's like a good concept, and not all groups have that. I mean, I think one of the problems also is like, why do LPs pick funds? They don't want to get fired. So if you pick a brand and like if a big brand loses money, you're okay, because you'd be like, well, it's not my fault. It's a big brand. And if it's a small brand that loses money, there's more risk. So, as a small brand, you have to, you just definitionally have to be able to explain to people that you're going to do better than average. That's the way to justify investing in a small brand, because you're creating some career risk for the person allocating to you. In some cases, you have like, distribution groups that, they'll select a manager and distribute that manager to their clients or whatever. And, you want to say, I have allocation to a famous person's fund, or, a firm that like is oversubscribed. And so like I'm getting paid for giving you something that you can't get access to yourself or whatever. So yeah, there's some firms that like aren't selling returns. They're selling a brand, or they're selling allocation, or they're selling interestingness, or they're selling that they're saving the world. I think luckily there's a huge amount of LPs who do care only about returns, and that's the efficient part of the market, and there's lots of it. And so yeah, it's better to have good returns than not good returns. But do some groups build a business based on having good enough returns to keep raising their next fund, but they're more focused on the brand than on the returns? Probably.
Well, not just returns, but multiples specifically, and multiples on a certain level of cash. So if you could put, billions of dollars to work as an LP, maybe you're more flexible having a 2x or something like that.
Yeah. I mean, well, also that's not, by the way, completely irrational. Like I think if it's a 2x versus 10x, like if somebody said, hey, Erik, you get to put $10 into something, you're going to get a 10x return, or you can put $1,000 into something, and it'll give you a 4x. You'll do the 1,000 because you want $3,000 of excess, of the income, as opposed to $90 of income. And you don't really care about, your goal is to make the most money possible, and there's like different ways to get there.
Exactly.
But yeah, I mean, I had this debate with somebody, which was like, should Benchmark raise bigger funds? I'm like, well, if you were Benchmark and your only dream was to like better the world, like that was the only thing you wanted to do. And what you would do is you'd go to LPs who are nonprofits, the causes you care the most about, and you would basically raise as much as you could from them until you felt like you were no longer delivering alpha, so you could provide as much absolute income to the causes that you cared about knowing that like their second best option was probably worse than like your diminishing returns. So like maybe they weren't going to get like a 20x on their next fund or whatever. They only got like an 8x. But like, if that was your goal to only make the world better in your eyes as a benchmark partner, I'm going to keep sorry to the people at Benchmark. I think you guys are great. But like they should raise a bigger fund, but I think that they're playing for a lot of things. One, I think they probably do that. And so it's good. I'm so glad that they exist. They've taught everybody in the venture world so much. And I think they get to pick and choose who they work with. And I'm sure much of it goes to good causes. But they're also playing like they're competing with themselves in some way. And they're like in it for the love of the game, and they love investing. And they like, there's something like about the heritage of venture being a cottage industry that like maybe one of the impacts that they're having on the world is leading by example and teaching people not to raise big funds. So maybe that would be a counter argument. It's like, I think what you're seeing is like, I don't think there's any right or wrong answers to this stuff. It's just all context.
Do you think more venture is going to look more like Benchmark, or more venture is going to look more like Andreessen Horowitz? Venture firms trying to become asset management firms and just like consolidate.
I bet less like benchmarking. Or Union Square Ventures. I think it's great that they exist, but I think it goes back to the ambition thing. Like they are unique in that they have senior partners who recruit ambitious people by offering them something they don't need to offer, which is equal partnership. Like, and then by the way, leaving. And without retaining terminal value in the management company. Will that happen sometimes? Yes. Is that unique and unlikely to be common? Also, yes. And so like, would I extrapolate what a handful of firms have done in the world and assume that that's likely to be the path of the rest of venture? No, that would be like really dumb. It's probably going to be like a profit maximizing, like highly rational pursuit. And from time to time, there'll be people who've decided they're in it for like the love of the game, and they're probably leaving some money on the table. Or maybe they've decided like they're not leaving money on the table because if they decided not to do that, they wouldn't have been there in the first place. I don't know. But I bet you that's unique and not the norm. And I think people talk about it as if that's like the North Star. Again, I think it's great that those firms have been built that way. But like you're relying on a pretty unique pattern. It's almost like looking at how like Jeff Bezos built his business, being like, oh, we should all be like Jeff Bezos. No, like Jeff Bezos is unique. We probably have very little to learn from him. Like we're probably like, you have a lot more to learn from like an average founder who like used their average skill set to be slightly above average by doing certain things right. Like Jeff Bezos is a genius.
Yeah, that's really interesting. Talk more about the CoVenture story in terms of what were the big inflection points, right? Like I remember you started out by providing this sort of like technical co-founder for hire. Or for equity service, which is pretty innovative at the time, and then now you're $1 billion plus AUM across different asset classes. Talk about the different inflection points, and then I want you to reflect on if you were Ali Hamed in 2024 today and had to start over, knowing everything you know now, but CoVenture didn't exist, and where the market is right now. What would that path look like?
God, starting over sounds horrible. I don't know that I can I take a year off?
Yes, you can take a year off.
No, inflection points of the firm. So we had this kooky idea to build software for equity. We were like, well, there's all these non-technical founders, and they need technical co-founders, and they give way too much equity to people who like could code crappy apps. And we're like, well, we could code better than crappy apps. And that was the initial strategy. And it was good. Like we made a lot, I think we're really proud of what we did for our LPs. It wasn't a strategy that could scale because you had to like hire a bunch of engineers and have this like big overhead cost. And it turns out like you start to build crappy apps if you try to scale too fast. And also people didn't want to like have like an outsourced technical co-founder, like broke the mythology of startups. And like every VC is like, well, you need a technical co-founder. And so it went really well in that it got us like on the map. It taught us a lot. Everybody who was invested were proud of what we've done with them. And I think they would, if you called them, they would say that they like us a lot. But it also was like, by doing that, we ended up investing in a business called Produce Pay. And that was like a big inflection point. Produce Pay was financing perishable produce farmers. No one had ever lent against perishable produce. They don't lend against produce, but they finance it by taking title to it while it's on consignment in terminal markets in Los Angeles or Texas or wherever. And they basically provide liquidity to the produce industry. And they needed debt capital. They didn't need venture debt. they needed asset-backed credit. They needed somebody to provide them the capital they were using to finance the produce that they were originating. And we thought it was a great credit because, not exactly this, but basically it felt like you were getting paid like you were financing a Latin American farmer, but taking the credit risk of a US-based distributor. So it was a pretty good credit. We raised an SPV. Why did we raise an SPV? Because we had no business doing credit. But our LP saw the deal. They liked our diligence. They thought we were honest. And we raised an SPV around it. And it was a way for us to generate revenues and build the firm. And then because we did that deal, we started getting sent all kinds of deal flow from all these VCs that had never really wanted to meet with us, but suddenly wanted to meet with us because we were willing to finance their companies in a different way. And it was the coolest thing ever. It was all these people that I'd always wanted to meet. So they wanted to meet us. And I was wow, this is amazing. Maybe there's product market fit here. And so we did this SPV business for a number of years. We raised some equity capital into the management company because it turns out investment professionals are expensive, and I didn't have any, real money myself at the time. And so I needed operating capital. So, we raised money from a gentleman named Mark Spilker and a handful of other people. Mark had been the president of Apollo. Before that, he ran GSAM, and he's just been this incredible mentor and partner of ours. He helped us figure out who we needed to hire, how to build an investment process. We hired people who really had done structured credit for a while. And we kept doing these SPVs until 2019. We went out to all of our SPV investors and we said, hey guys, it'd be really great if we had a fund. We've been doing this for 5 years and we think we're pretty good at it. And, we'll give you maybe better economics if you give us discretionary capital as opposed to SPV capital. Because, SPVs is a stressful way to live. You commit to a company, then you go raise the money and you hope you get it in time. And it's horrible, and you got to communicate and be clear with the founder about it, but it's not fun. And so we had a fund, we raised our first vehicle that was discretionary in 2019. And since then, that's really the asset-backed business that we built. In 2020, we had a point of view that we were probably good at venture. I always loved venture. It's probably my first love. And because of all these people who had sent us deal flow and asset-backed credit, and because I mentioned in the beginning of the podcast, you can raise money either from people a good track record, or a good story. We had no story. It was we already had this credit business. I was going to run this other, strategy, but we had people we knew. And everybody told us we should raise a fintech fund. Everyone was like, oh, you should do a fund that invests in lending companies. No, that would be a terrible idea. It's so hard to run such a specific fund because if you assume that the best talent wants to work at generalist funds, and you also assume that the leading indicator of a good venture business is having the best talent, you can't do a very specifically narrow focus. So we decided screw the story. We're going to just raise money from people we already knew and who liked us and thought we were intelligent. And we felt like we had good deal flow. And we raised a fund that was small enough where if we led deals, great. And if we couldn't lead deals, that would be okay too. We think it went really well. It's I'm talking publicly, so I can only say so much. But, it gained us credibility and we're still in the business. So it went well enough where we're still in the business. And I think that was a really cool moment for me personally, because it was something I'd always wanted to do. And I felt a little rejected by the venture industry for a long time of being this credit guy and the software for equity guy. It's the first time I finally got to do the thing that all these cool people in the Valley were doing. And then it was weird. I felt like everybody knew something that I didn't. It's there was these hot deals and everyone's doing SaaS deals at 50 times revenue. I'm man, they're so smart. They can figure out why these deals are good, but I just can't figure them out. And it turns out nobody, they all didn't know anything. I couldn't believe it. I was the emperor has no clothes. And so that's been pretty good. So that was a big inflection point when we realized that nobody really knew anything. And then in the hybrid business, that was the first time that we could go to our LPs and very quickly grow a business at scale, because we had spent, almost 10 years building trust and relationship with people. And that felt really good. And we thought, gosh, we're in business. So those are some of the inflection points, but there's no one moment. Every year feels like the hardest year of your life. And you look back and you're like, oh my God, I can't believe we're here. This is so much better than we thought it was going to be. I don't know. It's maybe a terrible answer.
No, it's a great answer. Let's go back to if you were starting over. Let's 2024, you took a year, 6 months off, and you have the expertise that you have now, but it's 24 markets. You have relationships too, but you kind of have to start again. How would you think about it?
I would have a very hard time thinking that I personally would have edge if I was only exposed to one asset class. It's very hard to out venture people. It's very hard to out asset-backed credit people. So I'd want a strategy where I could see one market and use the insights from that market to invest in another. Maybe that's not the best way to win, but it's the way that I found that works, and I'm just rolling with it. I would want to work with the same people. It took a really, really long time it takes a long time to find the people that you want to work with forever. I honestly, when you asked the question, I was like, God, you mean I'd have to rehire and find good people over again? So I'm going to assume I wouldn't have to refine people. I'd bring all the same people back. And I would probably just leave all the I think in the beginning of the firm, we wanted to make life really simple for the companies we invested in. And so we said, just come to us, and if you need capital, we'll figure out how to get it to you. And then on the back end, we're with this machine, raising SPVs and raising different strategies and doing all these different things and creating complexity on our side so that our companies never felt complexity on their side. I think the main difference is we don't have to do that anymore. But I would go slow. God, I feel so confused about the market. Do you read the news and feel clarity? Because I don't. Nothing makes sense. So I think that my answer would be I just go slow. I mean, we're going slow right now because we don't think the world's too good or too bad. We just have no freaking clue. And the hybrid thing, we always tell people is it's great because it's short duration. So you get the money back in time for when the world becomes more obvious. We try not to pick valuation. So we get our returns through structure as opposed to picking price. And we give up a little bit of upside for that. We try to invest in companies that are already profitable, so you don't have to rely on the capital markets to raise their next round. So basically, it's the I don't know strategy. And it's good. It works. Actually, it turns out when you don't know that you can still invest. But yeah, I'd go slow. I mean, I don't know. I think most people who go on podcasts are big promoters. And I'm kind of sick of it. And so I don't know. I'm going to, whatever the anti-promoter answer is, I'd go really slow.
Chop wood, carry water. I appreciate the answer because I'm effectively living that question now, right? After 8 years at Village, I'm starting over. And so I have, you mentioned great track record, people want to back you.
Come work out of our office. We'll look at stuff. We see all these crazy deals. We have a bunch of people. We're a little nerdy, so you might hate that, but we're fun. We work our butts off. Whatever hour you come into the office, there'll be somebody there because we work 100 hours a day. So yeah, just come hang out with us.
I'd love to.
This is a recruiting meeting, not a podcast.
Yes, exactly. I mean, I'm really reflecting, and I'm reflecting here in public with my audience on how exactly I want to play venture, because if I would have just stayed, I would just continue doing what I was doing. But now I'm really reflecting first principles, what makes sense in 2024. I have two of those three things you mentioned. I have a great track record. I have people who want to anchor or back me, but I don't yet have internal conviction on the story of how to play venture. I've been obsessed with the last decade of sort of the YC approach to venture, which is you go early, you go at meaningful scale, and you build a value prop with things like Product Hunter on deck that help with customers and talent that gets you, into the best deals and sometimes even special economics. And today, it just seems much more crowded. YC itself has moved up market. It seems like some of that alpha in early stage is harder. And so it's not obvious to me what kind of firm I should build. And so what I'm first focused on doing is kind of building these assets that, like Product Hunt and On Deck, solve for distribution. You mentioned Megaphone, solve for talent. I'm very interested in expert marketplaces. If you own Tegas, for example, is the way to monetize selling to VC firms if you get special insights on trends, companies, people, products, or should you trade on that information, or should you do both?
You should definitely trade on that information. You should not sell proprietary information that gives you edge. That's the easiest answer.
So how would you think about it if you were me, given your knowledge of my skill sets, interest, given, what I just said about the things I'm going to be working on for a bit? I've never thought about doing other asset classes. What advice might you have to me?
I actually have been talking to a lot of my friends in venture because I feel like everyone's rethinking venture. And I actually think that they shouldn't at all. I think they should go back to where we were in 2014. So I'm stealing comments from Jesse. who I already alluded to, but I think he frames it so perfectly. I'm paraphrasing, so he'll take credit for the good parts and not for the bad parts of what I'm about to say. Like seed investing 1.0 was like a bunch of people who were kind of random, and like they didn't all work at VC funds before they did it. They were just like tech founders or like former finance people or like whatever. And they invested in seed companies, and like nobody really thought they were good or bad necessarily. Like, and by the way, and they all just took a unique point of view. And some of those seed funds were really bad and they failed and they died. Some of them were really good and they became like super disciplined but oversubscribed, and nobody can get into them anymore. Or they turned into like multi-stage, like smart beta funds. And then like somehow what happened was everybody, like all these LPs wanted to stop taking career risk. And so they like would go to these like former people at like these like multi-stage smart beta funds and be like, oh, you should take like the multi-stage smart beta approach to seed investing. And like the multi-stage smart beta approach was like a lot of market maps. Oh my God, VCs love market maps. So you build a market map and you're like, oh, this is like an interesting space, and I'm going to like find the company in the space that I like the most because like the founder's good and like there's a feature set in the space that's good or whatever. And I'm going to like try to like use my brand to like win one of the rounds in the company that I like. Or if not that company, like one of the other three companies I think has a pretty good shot. And then like they like left those smart beta multi-stage funds and started seed funds. And like it doesn't work in seed. Like you only get one shot. You don't have a big brand. And so the way they try to compete is they still built market maps, and they still try to like find the winning company or one of the three winning companies at a chance or whatever. And then they paid like 100 times revenue for it. And they were like, oh man, venture's broken. No, venture's not broken at all. It's just everyone fucked it up. You know, I would go back to normal venture. That's what I would do if I were you. You have really good deal flow. You have a unique point of view. You've seen so many companies get built. You're probably better at it than you've ever been in your life. You're entering the age where you're like peak career, especially for venture, because it's kind of a young person's game. And just like invest on a unique point of view. And then as soon as you invest, convince everybody why it's a good idea. And then that's your business model. Like, so do what venture was supposed to do in the first place. Don't rethink it. Actually, like unthink it, like unscrew it up.
back to basics. And gearing towards closing here, it's one thing I just want to say about you which is really fascinating is, I feel like I know a lot about the sort of the players in venture. Like I can name a lot of firms and their strategies the way that like a big basketball fan can name like the best high school players or something. Like people really follow this.
It's like the best video game. Yeah, it's like the best video game ever.
But I don't know anything about baseball, for example. Whereas I feel like basketball, baseball, football, like all sports. Like when you talk about, credit and insurance and other asset classes that other venture capitalists know nothing about. They don't even know the firms that you mentioned earlier as that are the top of the game. How do you do that? And for people listening in who say, hey, I kind of want to diversify my knowledge base a little bit and not just, study all about venture, but also about other asset classes. What advice do you have? Like, where's a high leverage way to learn how to do that?
It took 10 years, so like.
But talking to people?
Yeah. First off, you do a thing and then you try to find something like tangential to it. And there's like things that I don't know anything about. Like if you ask me about like which long short equity funds, hedge funds are good, I really couldn't tell you what makes it great. I'd like listen to an analyst talk about a stock and like try to figure out if I think they sounded smart or not. That'd be like my best idea of how to like underwrite a long short equity fund. So no, I know about a handful of asset classes and I try to go up and down the capital structure of companies. But I mean, it's looking at a lot of deals. I guess I'll answer it differently. I'll say when we're trying to do a new space that we haven't done before, and the way we learn about it is we try to make sure the space is like one step away from where we currently are. So we're not going from like over here to over here. And then we try to like look at 50 of them because it takes 50 Bs to recognize an A. Usually when we look at a company, it's the same as looking at a space. When we look at a company, we ask ourselves three things. Like, what are the things that we need to believe for this company to work? Are we qualified to figure out those things? And would it be worth our time? And sometimes when we think it's not worth our time, but then we see like 14 pitches in the same ecosystem or space or asset class, we're like, shoot, maybe we should go learn about that asset class or ecosystem or space. So then we spend a lot of time. We try to get a lot of pitches. And then we try to co-invest with somebody who's been in the space for a while. And then we learn from that deal and we size it appropriately. And, we're not doing it because we think we're like just learning. We think we're going to make money on it. We've already seen a bunch of things. We think that we're now at least kind of experts in it. And we do it over and over and over and over again until finally we feel confident to lead deals in that space. And then we end up knowing the space really well. Insurance is a great example. Like, I think insurance is interesting because everybody in private credit has to think insurance is interesting. We had the great financial crisis. Banks had flighty liabilities, which SVB just found out. So, after the crisis, a lot of private credit investors ended up raising like shadow bank funds, like just regular LP funds. Some had a really good idea that they should buy insurance companies instead or reinsurance businesses instead. The nice thing about insurance companies is the same as depositors. They're regulated liabilities that are cheaper than what LPs demand, but they're better because in life insurance and retirement annuities, when you owe the money back, whereas banks don't know when their depositors are going to pull money. It's okay, better place to hold, alternatives. And like all these, private credit funds basically started doing their deals using insurance money instead of LP capital. Okay, so fine. So like I'm in private credit. A lot of people in private credit know a lot about insurance. I should try to learn a lot about insurance. So I used to call like all these private equity funds that bought insurance companies and made a lot of friends with people who work at insurance companies and talked to people like Drew, who runs an InsurTech venture fund, Drew Aldrich, you probably know. And then I got to the point where I realized like I know more about insurance than the average VC, but not a lot compared to the person who's buying insurance companies. And, at one point we thought, gosh, should we buy an insurance company to go along with our private credit business? And that would have been bad because that would have been the dumb money in the room. And so then we thought, well, maybe we should co-invest with somebody who could buy an insurance company. And we would even like put up most of the money and then like pay them economics or like an origination fee or something if they wanted to make sure they had skin in the game. But we couldn't find somebody who was willing to do it. I just actually had lunch earlier today with somebody who's like the deputy CIO of an insurance company. And so then we came to the conclusion that like it wasn't right for us, but we learned a lot along the way. And one day we'll have the opportunity to hire somebody who's bought a bunch of insurance companies before. And, the trade is kind of mature. It's not like it's a new idea anymore. So, if it's a new idea, it's easier to be an expert than when it's an old idea. When it's an old idea, people really are experts. So this is an old idea. We need to find someone who's done it a million times. And so I probably know enough to hire somebody who would be good at it, but probably not enough to do it myself. So that's like a way that we're exploring that space. The new version of that is the RIA space. So everybody did the insurance trade already. And then they're like, well, where else can we find money? And somebody was like, well, did you know like independent RIAs don't have that many alts in them anymore because a lot of their clients are accredited but not qualified purchasers. And, QP investors are usually the only people who can invest in funds now. And everyone's like, oh, great, we'll go start interval funds and all these other products that you can sell alts into RIAs with. So now we're spending a lot of time in the RIA world. I don't know. And then, we work like 100 hours a day. Like we don't have any hobbies. This is all we do. We're just like finance nerds.
What I love about your story is it's not just, hey, you read venture deals for every space. It's no, you got to get your hands dirty and like look at deals with the smartest people, earn your way to have the right to co-invest with them, to learn from them, and just keep like getting in the weeds.
I'll tell you this, it's not a market map.
Exactly. By the time it's a market map, it's too late, perhaps. Ali, this has been an incredible conversation. We're overdue for me coming to visit you in New York. I'll make that happen. Thanks so much for coming and sharing your wisdom with us.
Erik, thank you. I will talk to you soon.
Awesome. And I'm going to convince you to have a podcast at someday that it's going to happen.
I'm too grumpy, man. I'm just like, I have no good opinions. I'm too grumpy.
Well, if you listen to this and you thought Ali was, you want to hear more from him, DM him or DM me, and I'll send it to him because
you have something wrong with you. You should go read a book or something.
Yes.
All right. I'll see you guys. Thank you.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you liked the episode, please leave a review in the Apple Store or rate us on Spotify.